deep into the notes. See, wherever I have put in yellow, kindly look at those numbers a bit carefully, okay? Note 25, okay? There's something called Note 25 in P&L, right? No, this is not 25 for this company. That's it. Right? So kindly look at it. Sale of products. That itself they are splitting it. And other operating revenue, income from some, they are also rendering some services. They are also doing some consignment sales. Right? And there's also some government support, some PLI incentives. Okay? And they also do some scrap sales. And they also rented out their properties. All those income gets reflected. Okay? But largely the sales come from their sale of products. The whole other income are not that significant. So on a standalone basis, the number might be significant, but on an overall basis, when compared to the overall top line, it may not be that significant. Right? And look at less trade, discount, promotions, volume rebates, returns, etc. Discounts are increased. Discounts have increased higher than the increase in sales. Correct? You all agree with me? Okay, which means the operating environment, the competitive intensity has increased. Right? So every number, every increase and decrease has a story behind it. Okay? By asking questions, you will have to figure out. Right? Why keep on asking and then figure out. Right? Trade discounts, promotions, volume rebates, returns, etc. Right? It has increased. And that increase is actually higher than the increase in contracted price. Agree? Okay, which means they are pushing the products by giving huge discounts and rebates. Right? One reason why I chose this HUL is their balance sheet and P&L is supposed to be one of the most transparent in Indian context. Okay, the professor who taught me accounting, okay, he taught me using this balance sheet and P&L only. Okay, that time itself he told this is the benchmark as far as we are concerned. Okay, in a sense it has a fairly transparent P&L and balance sheet. That was the precise reason why I chose this company. Right? So you please look into those details, trade discount promotions. And the company is selling so many products. Okay, can anybody name at least the 5 products that HUL sells? Quality Walls is ice cream. Okay. Huh? No, you tell me the brand name. Lakme, okay. Okay. Surf Excel. There are so many products, right? And across so many categories. So those categories are shown here. Home care, beauty and personal care, foods and refreshment, others. They also do some exports to some small countries on behalf of Unilever. That comes under the exports and consignment sales. Okay, so segment-wise reporting. This is also very, very important. Every company has so many segments from which revenues are generated, and how those companies classify those. Right, home care, beauty, personal, foods and refreshments, others. Actually, next year, this foods and refreshment might be actually showing a steep decline Why? Okay, demerger, right? They are going to demerge quality walls. Okay, so that will go out from goods and refreshments, a bulk of that number. Okay, so this year it is not reflecting. Next year definitely it will reflect. So when you see the same P&L next year, you will have to ask yourself, right? Why is there such a decline? What happened when? Right? So that will give you very valuable insights. Going further deeper, other income. Say some investments they have sold. Some property or something they have sold last year and they also realized that the gain. Okay. So these things and all, fair value gain on investment measured at fair value to profit and loss. Okay. There is some income there. The bank deposits, that has also actually gone up. Even I do not know, I'm not able to figure out how their bank deposits went up dramatically, but it has actually gone up significantly. Income from bank deposit, that has also gone up. Again, note 27, 29. See the steep decline in raw material consumed and even in packing material consumed. Okay. Either the raw materials would have become very cheap. There are two ways to interpret it. Either raw materials would have also become very cheap, right, due to something, or they themselves would have procured little, anticipating decline in volumes. You can interpret it in either ways. Okay. Packing material consumed. Exactly. Okay, right? What amount of stock available last year? What was the inventory level? Okay, that and all. What was the current assets last year? What was the inventory level last year? That and all you'll take in. It will come from balance sheet. Okay, so that's the reason. Okay, we are connecting this program we also are bringing in balance sheet. We are also bringing in valuations, everything here. Only then you'll get a comprehensive picture. For the time being, I'm not coming to any conclusion. I'm telling either the raw material volume growth, okay, they would have anticipated lesser, so they would have bought lesser, or they would have already had an inventory in hand, okay, hence they would have bought less, or the prices of raw material would have also crashed. There are so many ways to interpret the same data. So similarly, the packing materials. Okay, I think their value that has also come down significantly. Okay, that has also come down significantly. Probably if you figure out the reason, you might get valuable insights on some other industry. Did paper prices come down, or did the plastic that they use for packing, that price comes down? You might have answer there. I think somebody here would be in paper industry. Huh? Something like that. Okay, they would have done it. Or if international paper prices or packing material prices would have also come down. Huh? Yes. So okay, it can be anything. Okay, so this in standalone. Okay, you'll have to just ask questions. Then when balance sheet also comes, okay, then you'll have to link both and then figure out the exact reason. Okay, it's not that easy interpretation of numbers. நான் அதை கவுண்டர் பண்ணட்டா, ஆப்ரேட்டிங் என்விரான்மெண்ட் ரொம்ப டஃப்பா இருக்கிறதுனால இன்னும் கொஞ்சம் கூட மைக்ரோ சானிடைசேஷன் கூட நடந்திருக்கலாம்ல. சரி, 5 ரூபாய்க்கு ஒரு பொருள் விற்க முடியாததுனால அதை நீ 2 rupees நீ குறைச்சிக்கலாம். அந்த ஷாம்பு சைஸை குறைச்சிருக்கலாம்ல. இல்ல. Okay, in the trade material, in trade discount, you are able to understand it, right? Some operating environment is tough. So when operating environment is tough, okay, they would have actually either reduced this Or the other way around also I can interpret. The premium products are doing well. Okay, கீழே வந்து the bottom products are not doing well. அதனால கீழே bottom products வாங்குறதுக்கு தான் நிறைய பேக்கிங் அதெல்லாம் தேவைப்படும், அதை வாங்கவே இல்லை. Right? So interpretation is very easy, right? So if 10 people have interpreted the same data in 10 different fashion, right? So that's the reason don't interpret anything in isolation. Just wait, just figure out, okay? Yeah. The contracted price, the price at which they have agreed to sell to the distributor. அவங்களுக்குள்ள கான்ட்ராக்ட் போட்டுப்பாங்கல்ல. Yes, that is a contracted price. So take for example 100 cartons of say some X good. Okay, they would say I would sell you at 7,000 rupees. அதான் அவங்களுக்குள்ள இருக்கிற agreement. That is contracted price. Then what would have happened is, okay, the 100 carton would not have moved. Okay, so they would have told, okay, you pay me for 90, 10 I'll give you as a rebate or free. Okay, that's what they adjusted. Right? Yeah. Peter, your other income goes up, right? Yes. No, it is affecting P&L. This is getting reflected in other income in P&L. No, they sold some property. It's a cash. Fair value gain on investment measured at fair value through profit and loss account. Cash. Okay. In the book, the book value of the property would be 1,000 rupees. Okay, they would have sold the property at 1,400 rupees now. So the 1,000 and 1,400 difference, they will have to realize that. And then bring it to, the property would be in balance sheet. It won't be in P&L. Correct? It is an asset. It would be in the balance sheet. Okay, when the property is sold at a higher price, then they'll have to bring it to P&L. There's some asset, some investments are some asset, yes, which is classified as investment. An asset which is classified as investment is sold. Right? Realized. But that will also come to P&L then and there. Okay? Okay, when you analyze banks, okay, whenever in the treasury income, okay, you can see that very well. And even in IT companies, okay, sometimes you will have it. Or in some companies, they will have cross-currency losses. Like if you take a Tata Motor balance sheet, you will see that MTM cross-currency loss many times. Note 30. Note 30 is all about your employee-related expenses. Okay? Okay, these are like your fixed costs. They'll have to necessarily go up. Right? Otherwise, you can't retain talent. And like your fixed costs, they also went up. This thing. Right? With some materials purchased? No, see, if I buy an asset, right, it will straight away go to my balance sheet. It reduces my cash reduces. Okay, my bank balance reduces, but my asset increases. No. It depends, right? If it is going to be a capital asset, okay, or if it's going to be investment, it will not affect your this thing. Right? It will not affect, it will not show up directly. Okay, anyhow, it won't show up. Note 31 and 33. These are finance cost, depreciation and amortization expenses. Okay, and other expenses. The other expenses, advertising and promotion. Okay. What's happening there? Huh? Yes, sir? How much is the increase? Just do a percentage increase now. 4,800 to 6,300. Roughly 30% increase. Okay, but what about your increase in sales? Almost negligible, right? 1 or 2%. What is the increase in profit? Nothing. And what is your increase in what you call? We saw one more data where they were struggling there, right? What was that in P&L? Huh? Which one? Huh? Discounts. And here they are also doing heavy advertisement. So if you connect all the entire picture, operating environment is becoming tougher, competition intensity is going up, they are giving more rebates, more discounts, and they are also advertising aggressively. Okay? Are you able to connect everything, then figure out the FMCG environment at this point of time? Right? You just on the P&L but if you look at deep, okay, and if you connect the dots, right, everything falls in place. Agree with me? Right? Your sales and advertising expenses have gone up. Actually, you are buying lesser goods. You are giving more rebates. You are giving more discounts. Okay, and your advertising promotion expenses also going up. Okay, but your sales is not going up in that much. So the company is struggling. Okay. Wait, sir. Avasar padadinga. Still a long way to go for that. Time 10? 10 தானே 10:45 வரைக்கும் இருக்குல்ல time. Wait. Right. வாங்க. Yes, I was waiting for it. இவ்வளவு tough environment. Okay. அப்படி இருக்கும்போது the promoters taking more royalty. This isn't good. Actually, this company was a great company. Okay. It was a great company, but it became a good company, one notch lower because of this unnecessary increase in royalty. Okay. All the multinational companies in India do it. Okay. They take royalty, technology ko royalty kudukranga, brand ko royalty, upper fees for central services from Unilever Group. Right. That too, when the operating environment is tough, it is going up. Right? Probably, see, even great companies do make mistakes. And they did a mistake and they lowered one notch lower. When you Google and see, somebody Google, when you have Google with you, HUL increase in royalty, you will figure out this. You will tough இருக்கும்போது இந்த எக்ஸ்ட்ரா ராயல்ட்டி எடுத்துக்கணுமா நீ நல்லா இருக்கிறப்ப எடுத்துக்கலாம் or if you have taken it as a dividend nobody would have questioned you because you will be sharing it with the minority shareholders also, right? Such a good company, such a great company, I do not know why they resorted to such steps during a very bad when they are at a cyclical bottom, when they are struggling actually. Okay, it doesn't augur well. Okay, so how much royalty fee for central services, right? All those have gone up, right? Which they should have actually avoided. So when you look deep into P&L, okay, you almost all MNC companies find out this royalty part would be there. For Maruti, it would be there. Nestle, it would be there. Almost all MNCs, they take royalty and other things, right? So it's very, very important when you analyze such companies, you look into this aspect also. Huh? No, I'm not asking them to stop royalty. They could have continued the same royalty policy as they followed 2 years before. They need not have increased the royalty which they are taking during a tough operating environment. This doesn't augur well, doesn't convey. This is very bad optics. See, Indian companies, so okay, they'll take to some other route, okay. Right, they'll be a lot of related party transactions, RPTs, okay. I think they'll cover it then subsequently. It would be there. So when you critically examine the company, you need to look into all these numbers and then come to a conclusion. Then it is justified. So we'll have to figure out if they have actually given more brands now. Right? We'll have to figure out, okay, if they are given more brands. Miscellaneous expenses are bottom. I'll wait for some more time. I think I'm going a bit slow. I have lots to cover. Okay, miscellaneous expenses, that also gone up significantly. We'll have to figure out why it has gone up significantly, but nowhere you'll get a split. Note that these are our exceptional items in any, okay, which they have categorized. Okay. And these are all just a component of income tax expenses, some deferred tax assets and deferred tax liabilities. Okay, that is also getting reflected here. This is very, very important. If you do analysis, just interpretation. Analysis is something called vertical analysis and horizontal analysis. Yes, yes. What is exactly non-cash thing? See, in Tata Motors and Tata Steel, it would have happened. They would have done a lot of acquisitions, mergers and acquisitions. Okay. Those companies, whichever company they have acquired, okay, they would acquire at a premium. Okay, but now the companies would have become valueless. Their value would have gone down significantly. So that difference, okay, on the premium, they'll have to write off. The premium would be there in your balance sheet. You'll have to bring it to your P&L and write it off. They have done multiple write-offs. Chorus like Tata Steel would have done multiple write-offs. And Tata Motors would have also done similar write-offs. So this is very, very important. Vertical and horizontal analysis. Okay. Okay. Just forget so far this thing. Vertical analysis is very, very, very important. First, I saw a summarized P&L. Okay. Then I went into the detailed P&L using the notes. And then I am tabulating everything in an Excel, the detailed P&L. After tabulating in an Excel, what I do is, right, I take this revenue from operation, okay? I am expressing every item in that P&L as a percentage of that. Okay? Revenue from operation is 60,469 crores. Okay? So every item, okay, I am expressing it as a percentage of that 60,469. That is your operating revenue, right? Every item, and then I am tabulating it. This is called vertical analysis. Correct? As a percentage of revenue, how much is your salary? As a percentage of revenue, how much is your promotional expenses? As a percentage of revenue, how much is your interest expenses? As a percentage of revenue, how much is your cost of goods sold? I am dissecting everything and then doing that analysis. Okay, this is called vertical analysis. So for 2 years I do this, and then I just figure out each of these expenses would have either decreased or increased from previous year. By how much it has increased, by how much it has decreased. Okay, when compared to previous year, that is called horizontal analysis. Year-on-year comparison. Okay. First is vertical analysis, in which every item in the P&L, I am expressing it as a percentage of your revenues. Okay. And horizontal analysis, I am comparing how each of these expenses and each of these revenues has increased when compared to last year. Okay. So when compared to last year, the sale of products has gone up by 2.45%. Okay. When you tabulate everything in one single Excel sheet, right? You will understand the enormity in increase in each of the expenses or the decrease in each of quantum of decrease in each of expenses, right? So in the bank deposit, there is a 170% increase in interest from bank deposits. Okay, which means the cash levels of the banks has gone up. Okay, they sold on property, right? That would be in cash. Another bank will put a deposit about it, it has gone up. You can interpret it in that fashion, right? Okay. Similarly, your every expense, okay, you can actually interpret it. For every company, you will have to do this vertical and horizontal analysis, right? So I have done this for Hindustan Lever completely. So you can figure out how much quantum and how much decrease and how much increase when compared to previous year, and as a percentage of your revenues, how much the expenses increase and decreased. Okay, ideally, you should do it at least for 20 years. Okay, then only you will understand the company better. Okay, then only you will understand the cyclicality associated with the company better. Okay, see, this operating environment is challenging for HUL. Okay, they would have encountered similar or challenging operating environment 7-8 years back or 15-20 years back. They would have definitely encountered. In that time, what happened? Okay, that time the sales and promotions went up. In the following year, did the yield result or not? Right? You will have to figure out and you will have to do this. So vertical analysis and horizontal analysis of P&L. Yes. Both has to be analyzed. Right? If the number is not that significant, like it's going to be a 2 crore change or a 2 crore difference. Okay, when your top line is 60,000 crore, then it may not make any big difference. But if whatever you say is 2,000 crores or 2,500 crores, then it will make a big difference. Right? So you will have to do both. So easily you are able to understand a lot of trends and other things. And just look at the sales promotion expenses, advertising and promotion expenses, which have actually gone up significantly. Then finally, everything boils down to profit. Okay. Profit has not increased that much. Okay. Suppose you can also do this analysis. If instead of royalty, they have taken it as dividend, that would have straight gone to the profit. Right? It would not have been expense. They would have shared it with the minority shareholders and boosted their PAT. Okay. This penny-wise pound foolish. Just Google and see when the royalty was introduced. That day, the stock crashed big time. By how much percentage it crashed? They are taking some 200 or 300 crore more, that's all. But the stock fell by 7 or 8% that day. Just go back and see, and they lost 50,000 crores, 60,000 crores in market cap. Penny-wise pound foolish moves. Every company does it. This company is also no exception. They did it. Yes. Now, after doing this vertical analysis and horizontal analysis, first we understood what P&L is. Then we saw what a summary P&L is, and then we figured out each and every item in the P&L, and we did a vertical and horizontal analysis. Now you will have so many ratios with you. Okay, we'll have to understand and interpret those ratios. Financial ratios. Okay, why? Compare and contrast performance between time period for one company. Okay. You can also compare between companies. You can also compare between a company and its industry average. And you will also compare across industries. Okay. So this is a main purpose for using financial ratios. Okay. Please understand these four. Types of financial ratios. There are so many financial ratios: liquidity ratio, activity ratio, debt ratio, profitability ratio, market ratio. Okay. Liquidity, activity, and debt. I think it will be covered more by the balance sheet person. I'm covering profitability and market ratios. Okay. Profitability ratios. Profitability ratios. Okay, PAT margin. That's what net profit by net sales. Okay. Net profit by shareholder equity. That's return on equity. Okay. Net profit by total assets. Return on assets. Okay. Of these three profitability ratios, today we'll be extensively focusing on the first one, PAT margin. Okay. By looking at PAT margin itself, okay, you'll be in a position to understand the cyclicality associated with that sector, with that business, as well as how well run the company is. Okay, that's what we are going to focus over the next or the last 15 minutes. Market ratios. Okay, these are all standard earning per share, which I told. Okay, everything boils down to earning per share. That's it. Right, and then payout ratios. You need to figure out, right, how much percentage of the PAT the company is sharing with the minority shareholders in form of dividends. Okay, then there are also some obnoxious companies who will actually borrow to pay the dividends. Okay, so you'll have to be very careful. Dividend has to be from your either that year profit or accumulated reserves. Okay, so there's a ratio called dividend cover. Okay, where you simply divide earning per share through dividend per share and then figure out, okay, from where did the dividend come? When there's no earnings, okay, still if they pay dividend, then it's a cause of concern, right? You'll have to be careful. Financial ratios may not be of great help on a standalone basis, but it's a great tool when you compare the ratios across companies, across sectors, and across industries, right? The ratios will help you differentiate between high growth and low growth companies. The ratios will actually help you understand why some companies command premium valuation, while some companies command discount in their valuation to fair value. Okay, it will also help you understand the difference between large and mid cap companies. Right, it will also help you understand between good and bad companies. It will also help you understand between asset intensive companies and asset light companies. And it will also help you understand between value and value traps. Okay, if you are able to interpret everything perfectly. Right. So long-term track record of a company has to be steady. Okay, this is a long-term track record of the company which I shared with you, the Hindustan Lever. Okay. You can see earning per share going up, dividend per share going up. Okay, your revenue is also going up. Okay, and bulk of the dividend is also getting paid out as, bulk of the PAT is getting paid out as dividend. Okay, and PAT as a percentage of turnover. Okay, look at the bottom. That is nothing on the PAT margin. Okay, that is also shared here. Okay, for any company, okay, do this analysis, P&L analysis. Okay, last 20 years, list it down in an Excel. Or if you are a tool is capable of generating such things, then generate using such tools. HUL, okay, just look at PAT margin. Bottom, 20-year PAT graph. 20-year pivot margin, okay? And here this is 20-year PAT margin graph. What do you interpret? No. The entire 20 years, how would you summarize? Huh? Secular increase in PAT margin. That's what I wanted to convey. Secular increase in PAT margin. Okay, despite last 20 years, the competitive intensity has also gone up, right? Despite that, okay, they are able to increase their margin decently over the last 20 years. Okay, that shows the quality of the company or the strength of its brands. Okay. Similarly, the PE, as the PAT increases, the PE also gone up. Okay. So market is rewarding for that, what do you call, the consistency and the ability to increase PAT margin and maintaining it for 2 decades. 50 times multiple in actual reason. Right? That ability to do that. So how did the market perceive? So when you do the vertical and horizontal analysis for 20 years, and finally, okay, do a CAGR for all the growth rate, this will only throw up. Revenues went up by 9%, PAT went up by 12%, and the market rewarded them by delivering a 16% growth in share price. Okay. Ideally, for most companies, the PAT growth rate and the market cap growth rate would converge. Most cases it would converge. Okay. This is one sector where the profitability, okay, where the market cap growth is higher than the profitability growth. Okay. The reason, we'll see. I'm also comparing it with peers. Okay, there are so many companies, there are so many rivals for achieving in various segments or in the same category, right? Most of the companies, okay, they have actually managed to increase their PAT margin over the last 20 years across the board, right? So that is the reason why most of these companies actually command a higher price to earn multiple when compared to a steel company or whatever it is. Okay, the predictability of their PAT growth, okay, and their ability to increase their PAT margin across decades, okay, despite increase in competitive intensity. Okay, so markets reward them. Godrej Consumer. Okay, I think they reported some one-time loss or something last year. Okay, so that alone fell in the last year. Okay, if you take the last year out, even that would have also increased. Prepared by my team. I think they are also sitting somewhere here. Yeah, we took it from the annual report. Yeah, 20-year annual report. Photo. Yeah, pulled it into the Excel sheet and did it. I think they're also sitting here only. In comparison with PS market cap. Okay, just it's an academic study. Okay, how the market cap of each and every company has grown over the last 20 years. Okay, I'm studying the entire industry here. Right, almost everyone has shown a growth. But this is just a graph, doesn't show the quantum of growth. We'll go next to the quantum. Yes, comparison with industry average. Okay, Nifty FMCG, there's an index. Okay, I'm comparing that PE with Hindustan Lever PE. At one point of time, Hindustan Lever was actually trading at a discount to industry. See, till 2014 or 15. Then afterwards, it is trading at a premium to industry. Why? These are all you have to figure out. Right? The company came with 2 buybacks. Okay, and those 2 buybacks had a very positive impact on the market, and the company got re-rated. And they also started delivering. Okay? Just go and see when did they come out with buyback and what was the after effect of the buyback, and the market started valuing the company better after buyback, and then they did a very high buyback also. Okay, Which one? Buyback. They sense tremendous value in the company. They felt that the company is undervalued related to the industry. And then they did a huge buyback. They were even ready to delist the company if they were able to buy back 75%. But people did not give. From 61 to 66%, they were able to increase the stake. They were not able to get the remaining 9% back. Nobody was ready to render. Okay, so the company share price got derated, and they also started delivering reasonable growth, better growth after that. This is a peer comparison. 20 years, we'll have to compare the revenue. Just look at the CAGR growth across the peers. Okay? 20-year PAT growth across the companies, across the board. Okay? And then finally, how did the market cap grow? Okay? All the three CAGR, actually you can put it on single Excel, single sheet, and then see, you will understand. Right? Higher growth will translate to higher CAGR. Higher growth, if it translates to higher profitability, will definitely translate to higher CAGR growth in the share price. PAT, revenue, market cap. Yes. This is about a company which is very talked about these days. Okay? Growing quite fast, right? Quite fast. They're expanding left, right, and center. Okay? Just observe how the net profit has zoomed. At some point, I think the net profit was even in negative, and now it has zoomed because the company is going quite fast. Since the company is going quite fast, it's also growing profitably, the market is also rewarding. Their P is also getting re-rated. Okay? Historic PAT growth. At one point of time, the company was struggling. Nobody even gave a look at the company, right? They were the profit, PAT margin, everything was abysmal. But the moment they started making profit, the company starts rewarding. The market starts rewarding. Last 3-4 years, see. Okay? PAT growth percentage. Just look at the PAT growth percentage of the last 3-4 years. Astronomical. So the stock got re-rated, the company became nothing better. But for 10 years or 20 years, nothing happened. Right? So you have to, if you are monitoring your company, you need to monitor all these things. Right? By looking at the P&L, by looking at the PAT growth. If the PAT growth is sustainable, if they can grow over fast, then the stock would also get re-rated. IT. In FMCG, there is a secular increase in margin. IT, there is a secular decrease in margin over the last 20 years. It would be quite a bit surprising, actually. Yes, the competitive intensity is going up, right? And the customers are also, the currency arbitrage, whatever it is, that is also slowly waning off. And some challenges are also coming up in form of GCCs. Okay, so the profitability of the companies, it's coming down. Secularly, it is coming down. So this is the reason why many people are predicting the gloom and doom of IT industry, but I do not know if that will happen, but showing you. Huh? So better you analyze, I did analyze. Right? The reason why I did analyze mid and small cap, you will get the answer shortly, okay? Historical PAT margin. Okay, both the companies are from same sector. Okay. The first company, Bajaj Auto, is debt-free, so no financial leverage, sitting on cash. The second company has huge amount of debt. It has huge financial leverage. Okay, the first company, its sales are almost consistent. Okay, in the sense, the predictable. The second company's sales are not predictable because it is caters to diverse geography and diverse segments, right? Just look at how stable the profit margin is for the first company, and how unstable or how volatile the profit margin is for the second company. Okay, you are comparing two companies within same peers. So market also rewards similarly. Tata Motors PE multiple, given this volatility, okay, it will be around 10, 11, 12 types only. Okay, but whereas that company, okay, though it might be growing slower than Tata Motors, its PE would be significantly higher, 20, 25. So market rewards consistency. Okay, that's very, very important. If your company is consistent and if it's able to hold on to your profit margins, right, even if you grow slow, you will be rewarded better than a company which is highly volatile. Right? So you need to understand. இதெல்லாமே P&L வந்து PAT எடுத்து 20 years போட்டா கழிச்சிடும் PAT margin. You can understand the cycle. Okay, and just do your homework. Okay, why did Tata Motors margin fell between 2008 to 10? And why did it fall between 2017 and 19? And then why did it dramatically shoot up after that? Okay, similarly, why did Bajaj Auto's profit margin shoots up from 2009? Okay, and then become stable. இதெல்லாம் கேள்வி கேளுங்க and figure out the answer. You will understand the cyclicality behind the industry, and you will also understand what you call more about the company strategy and as such. Again, PAT margin. Okay, this is one company. Okay, Airtel. Just look at the operating profit margin or EBITDA margin, whatever it is, EBITDA margin, and then look at the profit margin. Look at the wide difference, wide gap. Something is going wrong between EBITDA and PAT. Right? Understood? Right? Something is going horribly wrong. You have an excellent EBITDA margin, brilliant EBITDA margin, but something going wrong. What is going wrong? Okay? Your spectrum charges, right? Your AGR charges, and to pay this, you take on loan, interest expenses, right? Whatever it is, equipment kuda romba damage illa. Idu moonu da AGR, spectrum, and to fund this, borrowing more. Okay, so just understand. EBITDA, it's beautiful. PAT is ugly. So you need to figure out why. There are so many such sectors. Yes, this is one company which is in monopoly. Okay. It's in monopoly. Right. Just look at the operating profit margin. Just look at the net profit margin. Can you guess the company? It's a monopoly. No, not IRCTC. Not Coal India. It is a PSU actually, surprisingly. Power Grid Corporation, somebody told. Right? Power Grid. See, so if you are in a monopoly, it's tough to monopolize. It's a regulatory induced monopoly. Right. So hence, I think the company has terrific margins. Otherwise, most other PSUs and all, the P&L and all, not worth looking at all. Okay, it will be so ugly, but this company is an exemption, that's all. Cyclicality versus margin. This is one cyclical industry, metals. Okay. Just look at how volatile the profitability, the PAT margin is for these two companies over the last 20 years. Crazy, right? Where operating and financial leverage both comes into picture. Okay, when the demand collapses, PAT collapses. When demand goes up and the steel or aluminum prices goes up, the companies mint money, the profitability zooms. Okay? But it is not consistent. Correct? There's no consistency. Right? Adicha 6 illati out, then. So you'll have to understand that. Okay? Just by looking at one parameter, PAT margin, okay, you will be able to understand the cyclicality associated with that sector. Now let's compare these two. Okay, FMCG versus in the metals. FMCG margin, எப்படி stable consistent, and just look at metals margin, how volatile it is. And that translates to consistent companies are rewarded, whereas cyclical companies are not that much rewarded. Right? So your HUL will trade at 50 times earnings. Okay, but Tata Steel or Indelco may not trade at 50 times earnings. Right? Average. So please understand, okay? Asset intensive versus asset light, how the PAT matters a lot. Yes. No. Okay. Because operating and financial leverage came into picture, you get such a graph. Right? To understand that better, you will have to do vertical and horizontal analysis. Okay? This is the outcome of that. Yeah, you do vertical and an horizontal analysis, and I analyze both Indelco, Tata Steel for the last 20 years. You will understand both operating and financial leverage. Adodi outcome வந்து market கொடுக்குது. We are talking about the outcome. I have already taught you vertical and horizontal analysis. Then how does market react? And this is the last slide, okay? I'm ending bang at 10:45, right? So, so there are so many sectors. These are just few sectors which I have highlighted. So all these sectors in the profit and loss account, see for these parameters. These are very crucial. If you understand these parameters, if you understand this big area of parameters, okay, you will be able to understand and appreciate that sector and that company better. Once you are able to do that better, your investment outcome will also increase. Right? It would be better and you will have a very good outcome. Right? So with this, I end the presentation. And if you have any questions, please feel free to ask. Gross refining margin. Gross refining margin, GRM means. Earning? Manipulations. Okay, I think you can ask TA to conduct another workshop for that. Okay, that cannot be explained in one session. Okay, that itself requires one day. Okay, thank you.
Thanks, Subash. May I request Venkatesh? May I request Venkatesh, past president, to come on stage to honor the speaker with a small token of appreciation?